Hi Nishant, welcome to the podcast. Thank you for connecting with me today. A small introduction to you of yours. You are a chief goal planner of Mind and Milestones, where you recommend financial products based on the client's needs. Currently, you are working with a lot of HNIs and also writing blogs, creating presentations for investor awareness. You are very popular on Twitter as Step by Step 88, if I'm not wrong. Previously, you were working with Gurgaon family-based office, and you have a lot of experience as an arbitrager as well. I'm sure I've missed a lot of things, so would like to hear from you from you in your own words about yourself.
Hi Neeraj, thanks for having me on the show. Basically, Neeraj, I started my career as an arbitrager. I was dealing in the price differences of cash market and future markets. Within future market, I was also dealing in intramonth spreads. So I was doing a lot of trading in all these things full time. The setup was provided by a stockbroker. We used to share 25% of our profits with the broker. 75% of the profits comes to us. The benefit of sharing those profits was that were not we have not invested a single penny. All the margin and everything was provided by the broker, terminal, office setup, and everything. Post that, I luckily got a job in a family office where I learned about investing in personal finance. Just about a year back, I started my own practice, and right now I'm distributing financial product based on clients' need and risk appetite. I'm
Great,
also
Nishant.
writing blogs and creating presentations for a Mumbai-based company.
Yeah, we have all read your threads on
Mm,
Twitter, and they are very well detailed and very informative. You
mm.
are doing a great job in investor education, as far as investor education is concerned. Let us take a step back, and understand the work which you used to do as an arbitrager. So more or less, what an arbitrage mutual fund does. I believe that you are doing the similar things. So I have a very interesting question here. Were you beating the returns that were provided by the arbitrage funds, or how did your return book look like when you compare it with an arbitrage fund?
See, when you compare a journey of a arbitrager with a mutual fund, arbitrage mutual fund, it's totally different.
Okay.
Why it is different? Point number one, in a mutual fund, the mandate of a scheme is to generate risk-free returns. We
Mhm.
were also doing risk-free arbitrage, but what used to happen in those times were um, there are two legs to a transaction. Let's say I want to buy in one exchange and sell on another exchange. There is a difference of 1 second to execute that transaction because I have to type and punch in at both the terminals. So there is a gap between that. So what we used to do is we used to play very short term market movements for 5 7 10 seconds as well. Let's say a stock got running, let's say 100 and 102, and there is a difference of 25 30 paisa. What I am going to do, I am going to buy at the lower exchange. So for me the stop loss will be the difference. What
Okay.
maximum is going to happen is I am going to square off at another exchange at the same price, so only transaction cost I am going to suffer. But in case the stock is running, stock is in its momentum, what I am going to do is I am trying that instead of 100 and 230, I can sell it at 100 and 250 or at 100 and 275 or even at 100 at 3. So our margins were very small. We used to trade a lot. There are multiple legs within a day. So it was similar to a high frequency algorithm trading, but we were doing it manually. By manually, I mean to say we can do it only in one particular script,
Mhm.
but a high frequency algo trader is doing it in multiple scripts at the same time based on a algorithm.
But as far as I know, aren't we not allowed to, buy on one exchange and sell on another exchange on the same day?
We are not allowed to buy on one exchange and sell on another exchange. What we used to do to complete a full transaction, there are four legs to it. I
Okay.
bought at exchange A, sell at exchange B. When the difference come down or
Okay.
difference is zero, I will buy back at exchange B and sell it back in exchange A.
I'm sure that must have been a great experience for you, because
Yes,
you would
yes,
have
yes,
to work,
yes, yes.
the accuracy would have to be to the point 0.1 paisa, I would believe.
Correct,
Okay.
correct.
So moving on, so right now, can you give us some more details on what you do today as a mutual fund distributor and in financial product distributor?
See, I am distributing multiple products.
Hmm.
For wealth creation, my idea is to distribute only mutual funds, although
Hmm.
I have empaneled for portfolio management services and alternate investment funds as well. But I prefer to distribute only mutual funds because they are very transparent and tax efficient. Uh,
Sure.
there are other products as well which I am distributing, for example, term insurance, health insurance, Sovner Gold bonds. I am also distributing Section 54 EC tax saving bonds. I am also dealing in secondary market for tax-free bonds, corporate bonds. I am also doing RBI floating rate bonds. So I am empaneled for multiple products based on the risk appetite of the investor and the need of the investor. We come to a final product that what is suitable for the client.
Interesting. So we will come back to discussing the value addition that a distributor makes to a client later on our in our discussion. But before that, let us take a step back and understand what really got you interested in personal finance and made you so passionate that you ended up starting your own business.
See, very early in my career, when I saw people managing their own wealth, managing their own money, I noticed they are making multiple mistakes. For example, they were the money was just sitting idle in saving bank account. The least they could have done is they could have just invested in a fixed deposit
Hmm.
instead of keeping it idle in a saving bank account. So things like these small things I noticed in people which they are doing. They were investing in traditional insurance products. So that all these things collectively got me interested in personal finance.
Okay. So now, when you talk to your clients, what are the financial goals that you see are missing in people? What are the some of the goals that are very important to look at, but people tend to, overlook those financial goals and worry about the smaller financial goals?
I will say retirement is the number one goal which people tend to miss. Reason number one is they forgot that previous to our generation, most of the generation were employed in government sector and they have the privilege of lifelong pension from the government. So they have a kind of social security. We are working private, we will not get any pension from any government body. So we have to arrange a corpus and we have to arrange a decent corpus so that the corpus doesn't fall short within our lifetime and we can live a respectable life where our children can look up to us as Mr. Dependable and we are not dependent on them.
Yeah, I've also seen in my own area of work that people don't really think too much about, retirement, and they're very short-term focus and think about buying the next car or buying the next house.
Correct.
But again, the whole idea of, thinking about retirement is not popular because people don't know the amount of money that they will need 30 years down the line to retire. So, can you just share some example of someone who is spending 1 lakh rupees per month today? How much money will he need 20 to 30 years down the line for retirement?
See, he will be needing a very decent corpus. I do not have the numbers. I have not done any numbers, but we can do it. So, if a person is spending 1 lakh rupees as on today, if he has to maintain the same lifestyle 30 year down the line, even in today's term, he will be requiring 1,30,000 rupees in today's term. Reason I have increased that 30% is on account of healthcare cost
Correct. Okay.
because healthcare cost is going to get added apart from the current lifestyle which a
Lifestyle.
person is
Sure.
managing
Sure.
is spending on. So we have to do a future value that what amount he will be
Hmm.
needing
Hmm.
after 30 years on per month basis
Hmm.
and what is the corpus that person will
Hmm.
be needing after 30 years and what is the SIP amount which a person should start doing to achieve that
So
corpus.
if you were to retire today, it would be somewhere between, say, 30 to 50x your annual expenses.
Somewhere close to 30 to 50x.
Yeah,
See, the multiple will depend on the age at which you are going to retire. If
sure.
I am going to retire at 37,
Hmm.
then I will be needing at least 50x,
Hmm.
because somewhere close to 45, 50 years are still remaining. I'm
Right,
assuming a life of 85 years.
right.
But if a person is going to retire at 60, 65, or let's say 70, so that multiple will come down.
Okay.
So that
So
multiple will depend on the age of retirement.
absolutely, absolutely. Apart from that, what have been your other key learnings in your life so far when it comes to personal finance? What were the moments where you realized that, you are investing your money in the wrong place, or, you have bought a wrong financial product, or you were, duped by someone just so that he could make some money out of you. Can you share some of those experiences with us?
I will give you two experiences. In 2007 or 8, I started a traditional LIC policy. I do not remember the name of the policy. It was 2000 rupees per month, and with some rider, 32 rupees extra was there per month. So the premium was somewhere close to 2032 rupees per month.
Okay.
So I gave a check for 2032 rupees. I registered a mandate as well
Hmm.
for that LIC policy. So apart from the check, one ECS got debited from my account,
Hmm.
and till date I have not maintained 2000 rupees in that account.
Okay.
So the course correction was very quick. I realized my mistake. So only 4000 rupees got wasted in a traditional financial plan.
But just discussing more on that traditional financial plan,
Traditional insurance plan.
yeah, what made you realize that that you are in the wrong product, and why is it a wrong product? If you can throw some light on that as well.
See, first thing is, a traditional insurance plan will not serve any purpose. It will
Hmm.
not give you sufficient life cover. It will not give you sufficient returns.
Correct.
So both the purpose will not get fulfilled. None of the
Hmm.
purpose will not get fulfilled.
Hmm.
This is the reason number one.
Hmm.
Reason number two is, these products have no liquidity.
Hmm.
This is only a one-way bus. You can just board it, and you cannot deboard the bus till the time destination is not reached. So
Okay.
that is also an issue for me.
Hmm. Hmm.
Liquidity should be there.
Hmm. So, what was your second experience that made you
Second
aware?
experience came quite late in my life, but
Hmm.
I bought a under construction builder floor. It was a Delhi Development Authority land parcel. On
Okay.
that particular 120 square yards of land, a private developer was constructing 4 floors. So building was almost 90% over. So I booked a floor. I booked one of the floor in that particular building.
Hmm.
So the builder never completed the rest 10% of the building. There was some dispute among the builder and his brother
Hmm.
regarding the title of the property, and I got stuck. So I sold that property below fair value. I made some money on that property, but it got stuck for 4 5 years,
Okay.
and that 4 5 years were very challenging. So my suggestion to all the viewers will be that we should not buy any under construction property, especially especially from big developers. Reason being, in a big project there is a involvement of GST, 4 5% commission to real estate broker. Uh, Again, till the time the possession is not complete, you will not be able to sell the property so easily.
So, are you saying that if one were to buy residential real estate today, they should wait for the project to get completed, even if it is from a reputed builder like a DLF or Godrej, or say any other realty players which are listed and well known in the markets?
I will say DLF and Godrej, they are in a very great financial health.
Hmm. Hmm.
But if we go back in the history,
Hmm.
at one point of time, Unitech was also at very great financial health.
Right.
So it is not a risk worth taking,
Okay.
because the ticket size of investment is very big.
Hmm.
It is not something which you can say, okay, no problem, galti ho gaya, we will do something else.
Hmm.
Because you are investing almost a very decent portion of your savings.
Hmm.
So I will say it doesn't make sense to buy under construction property.
All right. And Nishant, when it comes to managing the personal finance, and when real estate as a real estate in residential real estate in which one wants to live their life, at what point in time do you think it makes best sense for someone to buy a property? And secondly, how much down payment should they be able to pay to make sure that the EMIs are affordable?
I will say there is no particular age at which one should buy a real estate for living.
Hmm.
It's a very emotional decision.
Hmm.
It will vary person to person. There is no answer in any of the personal finance book which can answer this question.
Sure.
Regarding the EMI and down payment part, I will say you can make that amount of down payment
Hmm.
so that the EMI is not more than 30-35% of your net in hand post tax salary.
Okay. Okay, so that's a good thumb rule to use when you're buying a
Correct.
property, that the net EMI. And do you think that one should go for a 20-year loan or a 30-year loan? Because what I've seen is that the difference between the 30-year loan EMI difference between a 20-year and a 30-year loan is not much. So not saving a lot on EMIs there.
See, I will say whether you have taken a 20-year loan or 30-year loan or 15-year loan will not make a difference.
Hmm.
Ultimately, most of the people repay all the loan within 5-7 years.
Okay.
Okay, so I will say just to control the EMI amount, you can vary the duration of the loan,
Hmm.
but the idea should be such that you are going to square off that loan in next 5-7 years.
Okay.
If
That's a
it
good
is
idea.
going to take a lot more time than 5-7 years, then probably loan amount is more than what you can repay.
Okay.
I
Sure.
mean, you should wait. You should not take that much loan amount,
Okay.
which
So
is going
the
to take 10, 12, 15 years to repay.
So the idea should be that you can should be able to repay the loan in say 5 to 7 years, even though you may not want to do it, but the ability should be there.
Correct. Correct.
Okay.
Ability should be there. There should be funds there. You can keep the loan
Hmm.
to gain out of tax benefit. That
Okay.
is altogether a different thing.
Hmm.
But the ability should be there.
Right. Right. Okay. Now moving on. So you are also very deep thinker about risk. So how do you think about risk when you manage your own money? You manage when your client manage your client's money.
See, I will tell you first about myself.
Okay.
I basically keep my portfolio in three baskets.
Okay.
One, where I take price risk.
Hmm.
Second, where there is no price risk but liquidity risk is there.
Hmm.
And third, where there is no price risk and no liquidity risk.
Okay.
For price risk, I invest in mutual funds which
Sure.
are exposed to equities, so volatility is there. But my investment horizon is very long. Although I can say 10-15 years, but my idea is that I am going to pass on this wealth to my daughter. I will not be needing this money. So whatever SIPs I am doing, I will not be redeeming that in my life. That is what I am going to try. Let's say what future holds for me. Regarding the liquidity risk for products such as PPF, EPF, VPF, Sukanya Samriddhi, RBI bonds, where there is some kind of lock-in, you cannot easily withdraw the funds, the return is fixed and tax efficient. This is the second basket.
Hmm.
And third basket is where I maintain my liquidity. No price risk, no um, liquidity risk. That is where I park my money in simply a bank account.
Okay. So you have a very simple structure there then. Do
Correct.
you also have a very high risk bucket wherein you invest in fancy, latest products like crypto and the angel investments and stuff like that?
See, for doing any investment in any company which is just starting up, you need to have very sufficient net worth, let's say more than 5 10 CR.
Okay.
Because where you are going to invest, you will be needing 10-20 lakh rupees for investment.
Okay.
And that investment can go to zero. So
Right.
for anybody who has a net worth of 4 5 crore rupees, it doesn't make sense to invest 10-20 lakh rupees in an instrument which can go to zero, just in the expectation of higher returns.
Right.
So most of my investments are basically in well-regulated products like mutual fund.
Hmm.
Regarding the cryptocurrency, I know there is a lot of buzz around cryptocurrency,
Hmm.
but I do not see any merit in investing in cryptocurrencies because it is something which government can ban any day. It is just one regulation away from getting banned. Any country can do it. Right now, governments are not doing it because they are making a lot of revenue out of cryptos getting trading on exchanges.
Sure. Sure. So because of regulatory risk, you do not want to stay away from it or not.
Yes, yes,
Makes
I will stay
which
away.
which absolutely makes sense actually.
I will stay away from cryptocurrencies. I will stay away from invoice discounting. I will stay away from P2P lending. I will not invest in these as well.
Those products are again that require a separate podcast, I believe, to discuss those products.
Correct.
Okay, so apart from that, you also work with a lot of retail clients. So, what kind of expectation management do you have to do there? Because in the last 1.5 year, we have seen that people, have had these expectations of making 30 to 40% returns, and they are extrapolating these returns to long term as well, which in our both of our experience is absolutely not correct. So how are you, what kind of conversation do you have with your clients to tone down those expectations?
A lot of clients have recently approached, I will say prospective clients. I have declined to deal with them. Reason being, their return expectations are very high.
Hmm.
They are even considering a 20% return to be with modest returns.
Hmm.
So I have said, see, within 1 year, any return is possible.
Hmm.
Small caps have delivered 100% return, mid cap have delivered more than 70% return.
Hmm.
So these type of returns within 1 year is possible.
Hmm.
But even if we have to see the returns of small cap from the lows of March 2020 on a 10-15 year horizon, they will not be more than 14-15%.
Hmm.
So people forget about this, that there will be good phases, there will be bad phases, and the return of a long term will be averages of all these phases.
Sure.
So you have to you have to explain to them that how Sensex has behaved in the last 40 years, how returns have been there for mutual fund for last 10, 15, 20 years. You have to highlight the time phrases where returns were very good or very bad,
Hmm.
so that they can build their expectation accordingly.
Right. Makes sense. Makes sense. So now moving on, Nishant, do you use any kind of thumb rules when it comes to managing money?
See, I basically use one thumb rule, that is, I have to save 50% of my in hand salary.
Hmm.
Um, by in hand salary, I mean to say whatever you are saving in EPF, VPF, that is a part of your in hand salary. That
Okay.
is how I take this to settle down this equation.
Okay.
If my CTC is 100 rupees and 10-15 rupees are getting added to my EPF
Hmm.
and VPF, so I
Hmm.
take that in my saving portion.
Hmm.
Okay, so at least 50 rupees I have to save. Remaining 50 rupees I can spend based on the needs.
Okay.
Some expenses will be discretionary as well.
All right. So you have also thought deeply about term insurance and health insurance, and you also mentioned that it is always better to be slightly over-insured. Can you help us understand what do you mean by that?
See, most of the people take insurance. I have seen people who are earning 30 lakh rupees per annum, who are earning 50 lakh rupees per annum, who are earning 10 lakh rupees per annum. They all have the same term insurance of 1 crore rupees. They do not understand whatever they are earning today, the term insurance will be based on that.
Hmm.
Plus the liabilities, plus the lifestyle, plus how much dependent you have, all these factors will be considered. It is always safe to be over insured. Reason being, 1 crore which you have insurance today, 10 years down the line, the value of that 1 crore will fall down because of inflation. And
Correct.
if you are taking insurance for 20-30 years, you have to take into account all those things as well.
Right, makes sense. Yeah, so yeah, I have also noticed that people there is a lot of content on online and social media where people talk about creating 1 crore in 15 years, but no one realizes that the value of 1 crore in 15 years is going to be very low.
Correct.
So again, the expectations, just because 1 crore is a big number today, it may not be a very big number 15 to 20 years down the line. So that's why working with calculators and really understanding inflation works. Can you maybe if you have some thoughts on this?
I will say we should never plan our goal, especially the long term goals, in nominal terms. We should never say how much money we will be needing 20 year, 30 year down the line. We should always plan the goal in net real terms. We have to adjust the corpus post taxes and post inflation. That is how you should plan it, because taxes are also real, inflation is also real. Whatever you are going to save and invest on capital gains, you will be paying taxes, and inflation is going to reduce your purchasing power. So if you have a lifestyle where you have to spend X amount today, you have to make a goal that what X amount will become after 30 years, keeping 6-7% of inflation, and what returns you can generate 9 odd percent, 10 odd percent return for a 30-year long horizon, and there is a 10% LTCG on it. So you have to just take 2 odd percent of net real returns
Yeah,
and then plan your goals.
right. Makes
Mm.
sense, but people don't like to, factor in 2% of just real returns in their long-term financial planning. Everyone wants at least 7-8%. Again, we know that it is only possible through, investing in businesses through equities, but again, the expectations is something that one needs to really think about. So how do you, tone down your own expectations there and also tone down your clients' expectations? Because it is something that we have humans have very short-term memories, right? So we are only factoring in what we have seen over the last 1 to 2 years.
See, I will tell you two things about this. First, if I am factoring in 2% real return and I am just taking inflation as 6-7%, the truth is that the inflation for my lifestyle expenses will be more than that. It will not be that which RBI is publishing. It will be somewhere close to 8-9%.
Mm-hmm.
Plus, I totally agree with you that equities are going to generate much higher returns. So that is why I have taken that safety net over there. That because my lifestyle inflation is much more than 6-7%. So it is better to assume 2-3% of net real returns. If returns comes out to be more, it is a good thing, but we have to prepare our financial plan in such a way
Right.
that there are no disappointments,
Right.
because if 25 years down the line you are disappointed, there will not be much life ahead to course correct it.
Right. Right. Interesting. Okay, so now moving on, what are the top 2, 3 things you think that every beginner should take care, in their financial journey?
See, for beginners, I will recommend them, first thing is they should first of all create an emergency fund. An
Hmm.
emergency fund can be a simple recurring deposit. They can do a recurring deposit of 2,000, 4,000, 7,000, whatever their income is for 1 year. Whatever corpus get accumulated after the RD is matured, they can put it in a fixed deposit and continue that fixed deposit. Second thing is, in very initial part of their career, they should not be bothered about returns or how to optimize their investment, because corpus is not that big. If you have a corpus of 1 lakh rupees and you can generate a return of 12% instead of 9%, in absolute sense it is only going to make a difference of 3,000 rupees, which is not going to affect your life in a very positive manner. So initially in the career, you should focus on your career. You should focus on learning new skills. You should focus on upskilling. You should focus on your communication skills. These are the things where you should focus on how to manage your time, how to be more efficient, more productive, because these things will take you higher in life. And 2 promotions extra, 4 increments extra, this is something you should focus on in initial 5-7 years of your career.
Hmm. Hmm. So yeah, ideally, it makes sense for a beginner to not focus too much on returns, but after they have, focus after they have taken care of their risks in the form of say emergency fund, life insurance, and health insurance, they should just focus on accumulating a corpus rather than returns, which is what I have been also talking about with people on Twitter and also on my clients. Absolutely makes sense. So now in this accumulation stage, where should they put put their own money?
In accumulation stage, see, after creating a emergency fund, Then you can take the journey of goal planning. By saying goal planning, you have to see when do you require the money. For example, if somebody requires the money after 2 years or 5 years for sister's marriage or for sister's education or for their own marriage, then they cannot take much risk with that money, correct? But if somebody wants to create wealth and plan for retirement or plan for goals which are 10, 15 years away, then they can start taking exposure in equity mutual funds.
Okay, makes sense. All right. So now, Nishant, you are also, a very deep you researcher. So whenever you are studying a subject, you do a very deep research, and you come out. You make sure that you've covered all the nooks and crannies of that subject. Can you, help us understand what is the process of your research so that we can also learn from you?
See, basically, whenever I decide to write on any particular subject, even before starting writing, I try to read a lot of stuff out there, not only with respect to Indian markets, with respect to other developed markets as well on that particular thing. So, what happens is your perspectives get open up. Apart from that, I like to explain the things with regard to regulations as well. And to understand regulations, I try to read about the act. I try to read about whatever information is out there issued by the department, concerned department. So by doing all these things, I am able to put up things, small things, which may not look important, but from a beginner's perspective or from a perspective of a person who want to know each and everything about that product in one single blog or in one single write-up, that things become important.
Nice, interesting. Thanks, Nishant, for that. So now, coming to the point of mutual fund distribution, both of us are mutual fund distributors ultimately. Why are
Mhm.
they seen, with a negative lens? Because in my own experience over the last year and a half, I have figured that mutual fund distributors do add a lot of value to their clients. So, what are your thoughts on this?
See, first of all, I would like to tell my viewers, just like me and Neeraj are mutual fund distributors, we have a very small book, but even the private banker with which you are dealing, he is also a mutual fund distributor. So it is not like that mutual fund distributors are bad or they are not ethical. You have to find a correct person. For example, me and Neeraj are running our own practice. We are not under any foundation to missell any product. No, none of our senior is pushing us because we do not have any seniors. We are the proprietors of our own firms.
Right.
But whereas in a private sector bank where you are dealing with your RM, he is under a lot of pressure to sell you mutual funds or to sell you high cost ULIPs or to sell you high cost traditional plans. So it is, you cannot see all those things from the same lens. Plus, regarding the value addition, you have to find a mutual fund distributor who can add value. Who can add value? A private banker who is selling you something and who will not be there when the product will, when your goal comes, because he would have changed the job, switched the job. Then there is no accountability on his part. His only job is to sell products so that his incentive, his bonus can get uh, approval from the seniors. That is his whole idea. But from the perspective of, let's say, me and Neeraj, we are going to do this thing for the rest of our lives. So for us, our reputation is also at stake. So we are not going to do any such thing by which just to earn a bit of tiny commission extra, we can earn something extra from you. One more thing I would like to highlight is, if somebody comes to us, let's say if a person wants to do a SIP of 10,000 rupees, he has two options, either to go to a fee only financial planner or to go to a mutual fund distributor. A fee only financial planner will not work anything less than 15, 20, 25,000 rupees for first year. A person who is going to save 10,000 rupees per month, these 25,000 rupees will look a lot to him.
Yeah.
And on the other side, a mutual fund distributor is only going to earn 8, 900 rupees in the initial first year. But for that 800-900 rupees as well, he is giving you a financial plan, he is hand holding you, and all these things you have to consider. If you can do it on your own, you can save those 800-900 rupees.
Right. Right. I think that makes sense, Nishant. Thank you for that. Thank you for your thoughts on that. Now, if so, where should one go if someone wants to be a DIY financial planner, do their own finances? Where should one go and learn more about financial planning?
See, to learn more about financial planning, you have to read a lot and you have to keep your portfolio very simple, because you have to understand this, that you are doing something else and you are just reading all these things just to manage your own money. This is not your profession. So for you, learning the small nitty-gritties is not that important, but you have to learn about the big strokes. You have to learn what are the things which you should not do, which are considered as mistakes. So first of all, you have to avoid doing any mistake which can be catastrophic in managing your own wealth. Second thing is, you have to keep your portfolio very simple. You have to get a life insurance, you have to create an emergency fund, you have to take a health insurance, you have to invest in diversified equity funds only. You need not take any thematic call, you need not do any direct stock investing, you need not do anything fancy where chances of losing capital increases. For example, invoice discounting, cryptocurrency, P2P lending. You should avoid all these things just to add 1-2% of extra return. You should focus on preservance of capital and you should have a long horizon and keep on investing.
Interesting, Nishan. So, on that point of investing in direct stocks versus mutual funds, I have had a lot of people come to me and ask me, do you advise on direct stocks? They only want to invest in direct stocks because they believe that they will be able to make larger returns when it compared to an equity mutual fund. So, what is the message for such people?
These are the side effects of bull market which we are going through. I will say most of the people are under the illusion that if we are investing in a blue chip stock, then there is no chances of failing, and then they will be able to generate much superior returns. So for all those persons who think that investing in blue chip stock does not have any risk, I will just like to give them a homework. Just go and check what were the blue chip stocks of 1990, 2000, 2010, and now 2021, and they can see the performance of blue chip stocks which were there in 2000. They can see the performance of blue chip stocks which were there in 1990. If they want to ask me, then how can we find blue chip stocks of 1990? Simply go and check the constituents of Sensex in 1990. Simply go and check the constituents of Sensex in 2000 and
Hmm,
check the individual stock return
hmm,
for all those 30 stocks. Then
hmm.
you will come to know that all these things which we think that it is very easy to spot a blue chip stock, it is nothing but just a survivorship bias.
Hmm. So you are saying that buy and forget does not work.
I will say buy and forget does work, but buying and forgetting an individual company comes with a lot of risk. You may get lucky, you may get unlucky. Just recently in our discussion, I used the company name Unitech.
Hmm.
Unitech was once a stock worth 10,000 rupees.
Right.
Now it is at 1 rupee. Adjusting for splits and bonuses, I think 10,000 rupees high is equivalent to 500 odd rupees.
Hmm. Hmm. Hmm.
So a 500 rupee blue chip stock is available now at 1 rupee. So there
Hmm.
are multiple examples of such things.
Correct.
So one should avoid direct stock investing. And even if one want to do direct stock investing, one should diversify. You must not invest more than 0.25% if you are a retail investor and your portfolio is very small. You must diversify.
So Nishant, on that note, do you think that a retail investor can create wealth, somewhere around say 50 to 100 crores? Is it possible for them through a vehicle like mutual funds?
See, to create wealth through mutual fund, you can create any amount of wealth. You just have to contribute accordingly.
Yeah.
It is not going to do miracles for you, and it is mutual fund will not deliver any kind of multi-bagger return. It is simply going to compound your money at 10 to 15%. You have to, whatever you are saving, it is the results will be with
Right.
reference to what you have saved.
Right. So basically, it's possible, but you need to put in a lot of capital in the initial years for the compounding to
Correct,
work in your favor and see the
correct,
results 20 to 30 years down the line.
correct.
Right, right. Thank you, Nishant. So now on that note, any recommendation for our listeners, any blog, any YouTube channel, or anything that you would recommend for them to, refer to?
I will say there is a book on personal finance. It has
Hmm.
been written by Morgan Housel.
Okay,
The book name is The Psychology of Money. I
okay.
will say it is a must-read book for everybody who is 15 years and above. The book will give you a lot of new insights about how finances can be managed and how simply having a high saving rate can go in your favor.
Thanks, Nishant. Where can our listeners reach out to you?
I am available at Twitter at step by step 888, step by step 888.
Okay,
I
sure.
also have a website moneymindandmilestones.com. Moneymindmilestones.com.
Awesome. I'll link those in the show notes to our discussion. Thank you, Nishant, for joining us today. It was a great discussion. I'm sure everyone will learn a lot. There is a lot to take away from our discussion today. Thank you for joining us. And maybe we should do another discussion wherein we talk about the in the flavor products like P2P and other such products. I hope to catch up with you soon. Thank you.
Definitely, Neeraj. Thanks a lot. Thanks a lot, Neeraj. Thank
Thank
you.
you.